Welcome to the Federal Retirement Podcast. My name is David Rates from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you can register by joining our email list at BFGKC.com. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website, BFGKC.com, or email me directly at david.rates@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoy this topic and hope to connect with you soon.
Welcome to Benchmark's webinar. My name is Patty Riley. I assist David and Gary Rates. For those of you that are new to our webinar, we do this once a month, typically the third Thursday. Questions are welcome. Feel free to type them in the chat box or unmute and ask. Today, our topic is getting your ducks in a row for retirement. I will now turn it over to Gary.
Well, welcome. I'm Gary Rates, founder of Benchmark Financial Group. David Rates, president, and I will be talking about getting your ducks in a row for retirement. Preparing for retirement is a big step for all federal employees who have dedicated years of service to our country. To ensure a smooth transition to this new phase of life, it's essential for federal employees to gather the necessary information to make informed decisions. Today, we'll explore the key steps federal employees should take to get their ducks in a row and prepare for your well-deserved retirement. So let's begin. David?
Well, thanks for tuning in to this month's call, everyone. Like we were saying a second ago, the theme of the day today is getting your ducks in a row for retirement. And feel free to chime in with any questions that come to mind. It always helps to get a dialogue going. So understanding your benefits. We thought it'd be important to just touch on some of the main bullet points for the three main pieces of your retirement income. So we're talking about FERS pension, the FERS supplement, or Social Security, depending on the age that you're planning to retire. And we'll touch on some bullet points with thrift savings plan as well. FERS pension annuity. It's always important to keep in mind the order of eligibility for survivor benefits. So numero uno on the list is former spouse with a court order. The key bullet point here is with a court order, not just whether or not you had a former spouse. We're talking about a former spouse where there's a court order that spells out in dollars and cents what that former spouse is entitled to. But it's important to keep in mind when you're retiring from the federal government, normally divorce decrees are written in quadro language, but the Office of Personnel Management requires a separate document called a court order available for processing, which spells out in dollars and cents what a former spouse is entitled to. So extra step there. So if you're in that boat, you definitely want to do some due diligence to make sure you got everything set the way that you want it to be. Second in line is current spouse. And then the last two, insurable interest in minor children. Those are very rare. We've never seen it with the clients that we work with, but I'm sure there's a situation where it's cropped up. It's just, it's almost non-existent that people would choose that option because you'd have to take a major reduction in your pension to leave your pension to an insurable interest. So surviving spouse benefits on your FERS pension. It's important to keep in mind that if you're in a boat where you're leaving the federal employee health benefits to a surviving spouse, you always got to remember that FEHB and the surviving spouse benefit are somewhat directly tied to each other. So in order to leave FEHB for a surviving spouse, you got to choose one of the two survivor options. So Uncle Sam gives you a choice. You got this gross pension, and they say, well, that's fantastic, but you can choose between the maximum survivor benefit, which is 50% of your FERS pension annuity, or the partial survivor benefit, which is a quarter or 25% of your FERS pension annuity. In order to leave the maximum benefit, you pay 10% of your gross pension on a monthly basis to leave 50% to a surviving spouse. And then for the partial benefit, you pay 5% of your gross pension on a monthly basis to leave a 25% surviving spouse benefit. It's kind of like a monthly premium, but it comes out of the back end of your pension check. So it's not like you need to write a separate check for that survivor premium. But like we were saying, or like I was saying a second ago, in order to leave the subsidized health insurance in the event that your spouse is a survivor, you got to go with one of the two options. If you just go with the life only option, then the second that the retired federal employee passes away, pension's gone, health insurance is gone. So that's an important piece of the pie if that's the situation that you're in. FERS retirement, regular versus unreduced FERS pension benefits. So there's three main bullet points to hit in terms of milestones of age and years of service to get to what they call an unreduced FERS pension. So number one would be minimum retirement age with 30 years of service, age 62 with at least 20 years of service, or age 60 with at least 20 years of service, and age 62 with at least 5 years of service. If you hit one of those three milestones, your calculation factor on your FERS pension is 1% times high 3 times years of service. Now, if you retire at age 62 and you have 20 or more years of service, that pension calculation goes up by 10%. So that's what they call the full unreduced FERS pension annuity. So age 62 with 20 or more years of service gives you a calculation factor of 1.1% times high 3 times years of service. So sometimes people are weighing the difference between going out at 60 with 20 or 62 with 20 years plus and trying to decide, whether or not it's worth it to get that extra 10% or whether or not they just want to be done and ride off into the sunset. So moving on, Social Security is always an important piece of the pie too. So some key bullet points to keep in mind with Social Security. The monthly payments continue regardless of economic conditions. So a year like 2022, when the market was pretty volatile, this is a monthly benefit that's payable while you're alive and well. There's no lump sum balance tied to it. So that's always important to keep in mind when you're weighing, the timing of when you'd hypothetically turn on Social Security. Social Security also has cost of living adjustments built in. So they're not necessarily guaranteed, but on an annual basis, they tend to increase Social Security payments based off the consumer price index. So, and the folks in Washington can come up with some colorful ways of calculating the consumer price index, but the important thing to keep in mind is that it's not a static payment. So, and then Medicare Part B expenses, which kick in when you're 65, are somewhat directly tied to Social Security as well. Assuming you're 65 and you're paying for Medicare Part B, they're going to take that premium, that monthly premium, out of the back end of your Social Security check. When you're looking at the benefit estimates, it's always important to remember the different age brackets that are available in terms of turning on Social Security. So we always, in our practice, we tend to gravitate towards turning Social Security on sooner as opposed to later. Usually the situation where people defer turning on Social Security is if they can retire from the government and then get a job working as a contractor, making enough income that they don't want to worry about the earnings test. So again, it kind of boils down to what your plans are as a retiree. So if you're planning to just retire and not necessarily go back to work in any capacity, then Social Security becomes an important decision to make in your overall retirement plan. And we always try to remind folks, so the reason the payment at age 70 is higher is you're getting a shorter duration of payments out of the pool of cash that Uncle Sam set aside to pay you as a Social Security recipient. So obviously the age 70 number is the highest benefit amount, but you're first eligible to turn it on at age 62. And then your full retirement age for Social Security hinges on your year of birth. So kind of the three main pieces would be the benefit that's payable to you at age 62, the benefit that's payable at your full retirement age, which is usually 65, 66 plus, benefit payable at age 70. So when you're looking at the Social Security statements, it's important to remember that the big bold number on the first page, the one that says your payment would be X a month, that's the payment amount that's payable at your full retirement age. You're circling back to the previous slide. When you're looking at these statements, you got to flip to the second page to dig into the details and figure out what your age 62 benefit is. So this is just a hypothetical example, but that blue circle would be the benefit payable at 62. And in this hypothetical example, this person's full retirement age was 67. So that's why you're seeing the three payment amounts: age 62 benefit, full retirement age benefit at 67, and then the age 70 benefit. In addition to Social Security, it's important to have a pretty good idea. So if you're in a spot where you can retire at minimum retirement age with 30 years of service or age 60 with 20 years of service, then you're going to be eligible for what they call the FERS retirement supplement. So it's not necessarily exactly the same as Social Security, but the FERS supplement mirrors Social Security in a lot of ways. It's just paid by the Office of Personnel Management, not the Social Security Administration. But it's designed to bridge the gap between your eligibility to retire as a FERS employee and your Social Security eligibility. So the calculation factor for that supplement is your years of FERS service divided by 40 times your age 62 Social Security benefit amount. And that's what gets you to that FERS supplement payment amount. So there's a few caveats that might cause the FERS supplement to be a little bit lighter. Like if you have military time that you bought back, that doesn't count in the calculation of the FERS supplement, which isn't ideal, but at the same time, it's also a nice benefit if you're in a boat where you can retire. Usually where people, we see people getting the FERS special retirement supplement is age 60 with at least 20 years of service. Moving on to TSP. It's always good to not necessarily look at TSP on a daily basis, but we always try to remind folks just on a quarterly basis, it's good to keep an eye on where you're invested relative to what's going on in the marketplace. And it's always good to stay on top of what your options are. So just a refresher, GF, CS, and I are the main TSP funds. So G is obviously the safest. It's short-term government securities. F is considered one of the safer funds as well as fixed income. So it's a bond fund. C is common stock index, which is essentially the S&P 500 index. I is international, and S is small caps. And in addition to those core funds, we've got additional life cycle options that they've added to the mix now too. So life cycle options range all the way from L income to L2065. So L2065 would be the life cycle fund that is going to produce the most growth potential, but it also has a little bit more variability than like L2025 or L income. So they can a little bit more conservative the closer and closer you get to that current year. So L2025 is definitely on the more conservative end of the spectrum relative to the investment allocation for L2065. Thought it'd be important to just throw this slide in there as a refresher on TSP returns for 2023. So 2023 was a little bit better than 2022 in terms of TSP fund returns. G was 4% to the plus side. F was 5.5%. C was up 26%. S was 25% to the plus side. And I was 18% to the plus side. So like I said, it's always good to just keep an eye on where you're invested in terms of the funds that you're using, and what's going on in the marketplace as well. And it's important to keep in mind as well that your balance of money in the plan doesn't necessarily have to be invested the same as your contributions going into the plan. So sometimes when people are getting a little nervous about what's going on in the marketplace, remember you can always keep the balance of money that you have in the plan for a finite window of time in a safer allocation like G, for instance, and then keep your contributions invested in CS or I. So if there's a downturn in the market to the negative side, you got your balance invested in the safest fund, but you're buying shares of CS and I with each biweekly contribution. Going back to that conversation about life cycle funds, a lot of times people tend to gravitate towards, for whatever reason, L2030 seems to be a fairly popular fund that people gravitate towards if they're using the life cycle funds. But the thing about life cycle funds is that they're a pie chart of GFC S&I. So on a quarterly basis, that pie chart gets adjusted slightly. So this would be a snapshot of L2030 distribution as of January 2024. And we try to remind folks that you can use the lifecycle fund distribution as a template and do it manually. Just the reason I say that is sometimes there are years like we flash back to 2022 where the Fed bumped interest rates a cumulative total of 4.5%. That was a year where it wasn't ideal to be invested in F fund, but that's not to say F is a bad fund. It's just the market's a fluid thing, and sometimes you get curveballs where it's not ideal to be in one fund and it's better to be in others. So 2022 would have been a better year to use G as your safe allocation as opposed to F, but it's not that way every year. So like I said, it's a fluid thing. That's why we try to emphasize getting in the habit of looking at your TSP statements on a quarterly basis and just monitoring it. A few years ago, TSP added the Roth TSP option. So some important bullet points to consider with the Roth TSP is you're always weighing with the Roth TSP, you've already paid taxes on the money that you're using to fund the plan. So the gain comes out tax-free, assuming that you tap into it after 59.5. So there's a few strings attached with the Roth TSP, but as long as you hit the important milestones, Roth TSP becomes a prime piece of property the further and further down the road of retirement you get, because it doesn't, now granted it's Roth IRA money or Roth money, but at the same time, it's not subject to required minimum distributions like the traditional side is. So it's a little bit cleaner and easier, but there's some important considerations to take in mind. So the further and further down the road of your earning years that you get, you start to lose a little bit of the tax leverage that ideally you want to fund a Roth early on in your career and then have this massive chunk of earnings that you can take out tax-free after 59.5. So if you're funding a Roth like on the tail end of your working years, you're going to be making presumably the most income that you've made at any point along the way. So if you're paying taxes when you're making the most money to take it out tax-free as a retiree, that's always something to take into consideration. But your contributions are, like I said a second ago, made with after-tax money, but the earnings come out tax-free, assuming you tap into the Roth money the longer of 5 years or age 59.5. So usually age 59.5 is the milestone that everybody's shooting for to tap into earnings tax-free. But the cool thing about Roth TSP is there's no income limits for your contribution. So like in the outside world with the Roth IRA, the more and more money you make, they start to whittle away your options for contributing to Roth. So that's why Roth TSP kind of becomes a nice piece of the pie. It's always important to get a refresher on your distribution options. So there's a few main distribution options to keep in mind. So lump sum payment, that'd be like taking it and putting it in your checking account, which if you're talking about the traditional TSP or pre-tax TSP money, you probably don't want to do that because if you put it in your checking account, you got to pay taxes at the point you do it. So this would be an example of sometimes people are kicking around like, should I take a big chunk out of TSP, pay off my mortgage and just be done with the mortgage payment? That's always a variable of, well, how much you paying in terms of interest on the mortgage relative to the tax hit that you take out a big lump sum. Another option is to transfer the balance to a traditional IRA or Roth IRA. There's a few more options. Usually you have a little bit more liquidity options, and there's more investment tools at your fingertips in the outside world. But that's not to say TSP is a bad vehicle for distributing money as a retiree. It's just you want to be aware of the cards that you're working with. So monthly payments, you can do a specific dollar amount on a monthly basis that you can adjust depending on what's going on. And TSP-L has an option for a fixed annuity, which is it's an option that they have to have, but at the same time, it's not the best option for annuitization. So it's kind of like the Model T of annuities. So moving on, in terms of retirement planning, when we're working with clients, we always run when they're getting closer to the door of retirement, we like to run a net monthly income comparison. So TSP tax info, withdrawals prior to age 59 and a half. So it's important to keep in mind that sometimes when we're working with people and they're retiring prior to 59 and a half, for a number of reasons, they'll oftentimes leave a chunk of money in TSP. And it's important to keep in mind that as long as you hit certain milestones of age and years of service, you can distribute money directly out of TSP and not have to worry about the 10% early withdrawal penalty, assuming that you start those monthly distributions directly from TSP after age 55, assuming you have 30 plus years of service. So usually people are in a boat, it's like 56 or 57, and they've got 30 plus years of service. You can start monthly distributions, usually is how the money gets paid out directly from TSP and not have to worry about an early withdrawal penalty. And then if you're in a special category or public safety employees, that'd be like air traffic controllers, law enforcement officers that have mandatory retirement ages, assuming you tap into it after age 50, you don't have to pay that 10% early withdrawal penalty. So nice little caveat of distributing money directly from thrift. Moving on to financial assessment. So going back to that point that we brought up about net monthly income comparison. So it's always a variable of how does the income compare on a net basis to what you're making while you're actively employed relative to what you're presumably going to be making as a retiree. And it's important to keep in mind that there's a lot of stuff that you pay for in terms of deductions as an active employee that go away at the point of being a retiree. So sometimes when people are looking at estimates for retirement income, they'll look at the pension estimate number that they get from HR, and they'll be a little wigged out because the gross income is quite a bit lower than the gross that they're bringing in while they're actively employed. But it's easy to forget about all those deductions that you pay for while you're actively employed as well. So, but we'll touch on that here in a second. So expenses are obviously an important piece of the pie. Savings allotments, if you get those coming out, whether or not they're going to be expenses at the point of retirement versus while you're actively employed, and gross versus net monthly income is always an important piece of the pie when we're working on putting a retirement income plan together for the clients that we work with. And earnings test is always an important variable too. So going back to if you're getting that first supplemental payment or Social Security, assuming you turn on Social Security anywhere between 62 and full retirement age, you're going to have an earnings test that's applied. So that's just in a nutshell. If you're getting the supplement or the monthly Social Security payment, you can't go make an unlimited amount of money because they look at it like you're double dipping. So, and then monthly deductions while you're actively employed. Like I was saying, it's always important to keep in mind monthly deductions as an active employee. So obviously federal and state taxes are always a variable that you got to be aware of. FEHB, dental, vision, flex spending account. So FEHB, dental, vision, those are two of the main deductions as a retiree. Obviously, federal and state taxes stay. Contributions to FERS retirement and TSP. Those are two that go away at the point of being a retiree. So usually TSP is a pretty big chunk in terms of monthly deduction while you're actively employed. So and then other taxes. So Medicare, Social Security tax, those go away as well. And most of the time people make an adjustment to the FEGLI that they have. So it's just a matter of which options that you have while you're actively employed, taking a look at what the pricing of those is going to be as a retiree and making an informed decision on what you want to hang on to. But most of the time, people see a reduction in that FEGLI premium, or the FEGLI premium stays the same. And I would say 9 times out of 10, people opt for what they call a 75% reduction. Usually they'll hang on to basic and option A and take a 75% reduction. So this is an example of that net monthly income comparison that we were talking about a second ago. So this would be a FERS hypothetical employee retiring at age 57. So this would be deductions while you're actively employed. So the whole point of this slide is just to give you a visual of how those deductions add up on a monthly basis. So in this slide, we're looking at this FERS employee, example employee number 1, retiring at age 57. Their gross retirement income is just shy of $11,000. They've got $5,700 a month in change coming out for current deductions. So that would put their net at just shy of $5,300 a month on a net monthly basis. So how does that compare to your gross retirement income for FERS example employee number 1? So in this scenario, we're looking at gross FERS pension after we subtract out the partial survivor benefit of about $3,200 a month. TSP IRA income. This example, the plan was to spin off $2,750 a month out of TSP money, and then they were looking at a first supplemental payment from 57 to 62 of just shy of $1,600 a month. So that put that gross monthly income at $7,575 on a monthly gross retirement income on a monthly basis. So how does that compare to the deductions that go away as a retiree? So like we were saying a few slides ago, obviously federal and state taxes are still a piece of the pie. FEGLI would be a monthly deduction for a finite window of time. FEHB is always a deduction that you're going to have to account for. Dental and vision, and then long-term care insurance. So this hypothetical example, retiring at 57, this person's deductions went $5,700 a month and change to just shy of $1,700 a month. So that put their net monthly income at $5,800, almost $5,900, which had them see a monthly income increase of $650 a month, so $649.48. So if you've ever heard any of the folks that you work with that have retired talk about being in a spot where they can retire and make as much or potentially more money as a retiree than they did while they were working full time, this would be a roadmap of how you actually get there. So if you're wondering how that happens, it's always good to have a roadmap that spells it out in dollars and cents of what you're going to be looking at in terms of net monthly income. So the gross versus net income on a monthly basis is a really important piece of the pie when you're talking about, well, hey, can I retire and make more as a retiree than I did while I was working full time? And for some folks, that's definitely a reality. So moving on to FERS example employee number 2. So this one's kind of slightly unique because it was a person that was going to retire at age 46 as an air traffic controller. So one of the caveats of that special category is as long as you have 25 years of service, you can retire at 46, for instance, and not take a reduction in your pension or your retirement benefits. So this hypothetical example, we're looking at gross retirement income of $15,700, current deductions $9,000 a month. So that put the net while this person was actively employed at $6,600 and change on a monthly basis. Same scenarios as earlier. So we got FERS pension with a partial survivor benefit, $5,200 a month and change. Just shy of $3,000 a month spinning off of TSP IRA money, and then the first supplement was $1,450 a month. So that put the gross at $9,600 and change. But the retirement deductions again went down quite a bit from where they were while this person was actively employed. So in this scenario, this person was looking at taking a monthly a decrease in their net monthly income, but that's not necessarily the end of the world because going back to that Social Security, your first supplement earnings test. So in 2024, if you're getting the first supplement or Social Security, you can go out and make $22,320 earned income and not have to worry about that supplemental payment getting reduced. So $22,320 annually is an extra $1,860 a month. So going back to this example, on the one hand, just based off of like your pension, TSP, and the supplement, if relative to the deductions that you're going to see as a retiree, if that puts you in a spot where you're down in terms of net monthly income, knowing that you can go out and make $1,800 a month and change is a nice way to fill that gap of that decrease in monthly income that you're going to see just from those three main sources minus your deductions. So again, this is just a roadmap of how folks get to those milestones. It's always important to keep in mind too that if you're getting the supplemental payment, that automatically shuts off at 62 because OPM says, well, now you're eligible to turn on Social Security. So, but the supplemental payment is just based off of your years of first service, whereas Social Security takes into account your entire working history. So it's not uncommon for folks to see anywhere from $500 to $1,000 a month auto increase just by moving from the supplemental payment at 61 to turning on Social Security at age 62. And circling back to a little bit more detail about that earnings limit. So non-work income doesn't count against the earnings test. So that'd be government benefits, investment earnings, interest, pensions, annuities, capital gains. Those income sources do not count against the earnings test. Self-employed income counts when you receive it, not when you earn it. And like we were saying earlier, in 2024 numbers, you can go out and make $1,860 on a monthly basis or $22,320 annually and not have to worry about that supplemental payment getting reduced. All righty, investment management. So one thing you want to ask yourself as you're going down the road of planning for retirement is that, do you have a really good handle on all your benefits and assets? Do you have a plan in place if you run into trouble? And bullet point number 3 is an important one too. Is it, do you want to manage investments on your own as a retiree, which is an important question to marinate on going into the retirement planning process. All righty. So how does the planning process start with our practice? Our first meeting is what we call a fact-finding meeting, where it's information gathering and sharing. So the more accurate the information is that we get from you in terms of identifying the benefits that you have, the more accurate we can be with the plan that we put together for you. So we always try to get folks to dig up just a recent leave-in earnings statement. Any sort of retirement estimates that you can find are always helpful. Recent TSP statement is always an important piece of the pie in terms of identifying information. Any other investment accounts that you want to have built into the plan, details on outside life insurance policies are always important. Social Security statement, if you haven't pulled one up in a while, it's worthwhile to just log back into the Social Security website and get it's just a recent statement. Divorce decree, if you're in that scenario, is an important one to just read back through and make sure you're on the same page with what it says and you don't get any unpleasant surprises, and any spousal benefits that you want to add in the mix. So like I said a second ago, our first meeting is a fact-finding, information gathering, and sharing. Second meeting, we put together a written plan for you that we call version 1. Sometimes those get morph into version 2, 3, or 4, depending on what people want to do. So it's a refining process, but it just breaks down all your options for each of the main pieces of the pie. So choices for your first pension, choices on what you want to do with your federal employee group life insurance, an idea of what the supplemental payment's going to spin off or Social Security is going to spin off to you on a monthly basis. We put together an income strategy for distributing money out of TSP, and then we run that net monthly income comparison that we reviewed a second ago. So, and then subsequent meetings, it's a refining process. So we finalize the retirement income plan. put together, implement the strategy, and then make adjustments going forward as life happens. So, Patty, any questions?
There are no questions right now in the chat box. Also, David and Gary are available to do in-person seminars at your agency. So if you and your coworkers are interested, let us know. David, do you have anything else?
If you think of any questions or something crops up in the back of your mind sometime in the near future, don't hesitate to give me a call, or you can always send me an email or just submit the question on our website as well. So thanks for tuning in, and hope to see you guys in the near future.